if anyone who's watching this today, and if I ask you this question, if you wake up in the morning and before you go to the bathroom, if you're not looking at what S&P futures are, you're probably not committed enough for me. Really good people in this business, they work so hard because they don't want to work. That's the irony. You have to live, breathe, and think, and just, act in every sort of conscious moment. If you're an active trader, think about that. The game of trying to predict months ahead, weeks ahead, years ahead, my crystal ball gets foggy real soon. I don't do that. That's not predicting. That's kind of gossiping. Trading and success is about eliminating the distractions and the gossiping and focusing on the discipline and the decision making, and that means risk management and really realizing when you're wrong.
Hi, I'm Tom Thornton. I'm with Hedge Fund Telemetry. And today on Real Vision, we have Peter Borish. Peter is a legend in the hedge fund world. He used to be Paul Tudor Jones's right-hand man. He has so many things to say about the markets. So let's talk about the current markets, all the macro markets as well. I want to find out what really makes a great trader, because Peter knows. So let's go and find out what Peter has to say. Well, Peter, thanks for being here today on Real Vision. I'm very excited to have you here to sit down, talk about the markets, talk about the world. Your experience in the hedge fund world is just unprecedented. So thank you for being here.
With pleasure. It's fun. It's an exciting time, and it's almost, think about it, it's a full cycle since both of us started in the industry back really in the mid-'80s.
For a lot of viewers, they got to know you as the #2 guy for Paul Tudor Jones at Tudor on a video called Trader, which it's hard to find. It's been banned by a certain person who didn't want it on the market, but it really is a legendary piece of work of two guys running a hedge fund in the late '80s. You were predicting a crash. Tell me a little about that video, what your thoughts are.
It's a little funny because, that video was filmed in the end of '86 and '87, and there's a lot of discussions today about the parallels of what's happening in the current markets in 1987, and we can go in that. I think that the most important thing about the video and what it says is how hard it is to be successful in this business. One of the things that we did at Tudor, and to Paul's credit, he was willing to invest in technology, in data, and in human capital and people. Sounds very familiar, again, to today, how you build a successful business. At that time, we hired summer interns to punch in data, to build this model. I was fortunate to be working with somebody who supported that, and then I was fortunate enough actually to build a model that turned out to be successful. I think it's really aged well. The video, for a long time, I think we all get embarrassed.
What we're showing you here on our YouTube channel is just the tip of the iceberg. No matter where you are in your financial journey, whether you're a beginner just looking to break into the market or a financial professional looking to up your game, Real Vision has something for everyone. Every day, our team of expert journalists provides in-depth analysis, written reports, access to live streams, and access to our community, The Exchange, where you can interact with people just like you from all over the world. For just $1, you can unlock all of this and more at realvision.com. Try our Essential tier. If you like what you see, it's only $20 a month thereafter. So click on the link in the description, go to realvision.com, and see what you think. We look forward to seeing you there.
Successful. I think it's really aged well. The video, for a long time, I think we all get embarrassed a little bit by success as a young age, and I think we felt like we were young athletes and we hadn't quite proven ourselves yet, and then we did well in the larger stage, which is the markets. But over time, I think we are more than one-hit wonders, and we can look back on that whole period and the trader video with fondness.
Market sentiment, it's extremely high. We see investors' intelligence, the oldest one in the world, at extreme levels, higher than 1987. And we see daily sentiment index making all-time highs just this week. We see margin debt skyrocketing. Tell me what you're seeing on that.
Well, I love it because it just validates what we were talking about before, that records are made to be broken. If I can get a little wonky for 1 second, trading is a second derivative issue. It's not a first derivative issue. It's the rate of change, not levels. So if you're telling me that, you know, an RSI is 90, people think, oh, I must short it because it's high. I look at it and says, if it's going from 85 to 90, it's not a short. If it's going from 95 to 90, that's an entirely different story. We've got the market that's in an inverse, as we said. If you put the charts upside down, it's like trying to catch a falling knife. All I know is that if you try to catch a falling knife and you miss it, it can land right in your heart. It's much better off to let it bounce a few times and then pick it up. So that's how markets behave. You're at the top. It's going to decline. It's going to go sideways. And then it's going to give some indication that it's breaking. It's not going to be a fundamental indication. That's lagging. We look to combination, all our traders, right? A combination of fundamentals and technicals. And when the fundamentals and technicals diverge, you may not want to trade. And oh, by the way, that is a valid trade. If I'm not trading on my terms, don't trade. Many people are sitting there in front of a screen and they feel like they have to do something. And you don't have to do anything. That's a discipline of trading. And when things come together and when the pattern's there, that's when you can take the shot. So again, you learn in school, the bigger the risk, the bigger the reward. Trading turns that upside down. If today is the high and I can risk a little, then I can put a big position on as long as I have that discipline to get out. And I kid around all the time because we've been in this super strong bull market, and I'm like, hey, the S&Ps are 2 handles off their high, the top must be in. Because everybody's looking for that high, but it isn't going to come like that. And then I go, well, at least I have a fallback career. If I can't do that, I'm going to go into the t-shirt business and say, one for each week. I survived the bear market on Monday or Tuesday or Wednesday, because that's how long bear markets have been right now. So, you know, we had the reversal the other day, and I broke out, I survived the bear market, a Tuesday t-shirt.
You have a new Fed chairman starting next week.
Yes.
And in 1987, you also had a new Fed chairman.
Yes.
And he moved aggressively raising rates, but the market kept going up until it didn't. Do you see any risk with?
I see far more risk that the market tends to challenge new Fed chair people. I see greater risk because this Fed Chairman Powell is a lawyer. He's not an economist. He's not a PhD. He hasn't been there. He's learned, he studies. It's funny, right? Because most people in that ilk, they like people with experience, not people that have studied, but you know, they're talking their own book. There's also appointing new people, and one of the appointees has been wrong for a decade, right? Again, before we talked about our political biases, and he's like, oh, Obama is going to unleash inflation, is going to ruin the dollar, and interest rates are going to go up. So instead of admitting that they're wrong and trying to better understand their intellectual framework for that, they just spoke louder and talked about it. And now we have a new president, and guess what's happened? The dollar has gone down and interest rates have gone up. These things, the pressures that have underlying symptoms that took place a decade ago, the deflationary pressures of changing technology and not fully understanding that on the supply and the demand side. And you could talk for another 2 hours about the economic policies of energy and other things and what's that going to do to those particular prices ahead of time. It's probably a mistake to get aggressive in terms of raising interest rates right here. As we said, Our rates are higher relative to the rest of the world, yet the dollar is declining fairly dramatically. The yen's back below 110. Look where the pound is back to where it was at Brexit. So yeah, you've got to be a student. You have to watch all those particular markets, and I think the Fed is going to be very challenged here.
Well, a lot of people are saying that 3 hikes this year are a given. I've even seen people say 4. You totally disagree?
I don't disagree that the people at the Fed are going to try to have a story and stick with it, regardless of whether it's right or not. That's what makes me nervous. You know, this is a business where we talked about it before. You look at the data, you look at the information, you look at the stock patterns, the technical patterns, and you better be flexible enough to change your opinions. I'm concerned that they're more dogmatic than they should be, and they're going to stick with their guns because they don't want to admit that their a prioris were wrong, and they're going to be raising when they shouldn't be.
You've told me many times that you're a deflationist. Tell me what a deflationist is.
Well, I start from the premise that the internet is the greatest deflationary machine that was ever built because it eliminates price discrimination. Now, I'm an economist. I'm going to go into the weeds here for a minute. I live in New York City. You have a small apartment and you don't have any closets, but you don't need closets anymore. It used to be your corner bodega was your closet. You could run out and get toilet paper or whatever else you need. But that was kind of expensive because you were paying them to store it. Now you have Amazon, Walmart, anything you need anywhere you can get in 24 hours or less. Markets work. So that's because you can see every price through consolidators, whether it's Travelzoo or Kayak or any of the other sites, you can get the lowest price possible. That puts deflationary pressure on there. Now we look at technology innovation. Technology innovation, and this is what I was talking about before on these policies, it works on both sides. At any given price, you're going to get more supply. But at the same time, and this is where people tend to forget, you're using it more efficiently through our nests, through other products, which says, oh, I'm going to reduce my demand. Great for the consumer. So I get more of it at a given price. I use it more efficiently at a given price. You don't need to be a PhD in econ to realize if I have more supply and less demand, what happens to price? So unless we see economic growth, which shifts the demand curve up, we are not going to see rising prices. And of course, today, this morning's GDP number was lower than expected. And by the way, I love it because, I'm an economist and my title is chief strategist. And so after the fact, I can explain everything perfectly. So here we go out, the numbers, it was because of inventory accumulation, we had more imports, but you could have seen all that. Yeah, so this is justification of bad decision making. And I'm really concerned that what could spark an issue in a more lasting market decline is a policy error.
We have a president who has never done politics in his life. He is a real estate developer, entertainer, tweeter. He could make a policy error, but a lot of things that he's done have worked. Look at the tax reform. It's jammed the market. People are making more money. Isn't that a positive?
Okay, I'm going to stay away from politics. I'm just going to state the facts, okay? The Reagan tax cuts, 1986, went into effect January 87. Bush tax cuts, 2001, went into effect in 2002. We all know what happened in 87. 2002, the market was down 25%. What's obvious is obviously wrong.
So would you say things are priced in? A lot of people are saying it. Without saying that we're at a top.
Yeah, yes. I think it's priced in. So, my dad, God bless his soul, is 90 and a half. And I'm like, Dad, I'm not buying a 115 call. Okay, we need to plan. I might do a 95, 105 spread, but you're not living forever. Risk management says that this market is extended. It's not going to live forever. Doesn't mean it's going to end tomorrow or the next day or the next week. Risk management says you need to be prudent.
What on your radar are catalysts, potential catalysts out there that give you concern, that could start some volatility in the market?
Well, again, I'm always mindful that everybody looks for a single cause for something to happen. I go back to sort of World War I, right? The single assassination, all of a sudden that started a world war. I think things are a bit more complicated than that. People look at 87 and, you know, oh, it was, you know, portfolio insurance, or they're going to look at the flash crash. It's always a confluence of events. And what's likely to happen is that it's extended, that there are fewer natural sellers in the marketplace today, which means that as you decline, there's fewer natural buyers. That's what leads to acceleration. If everybody's on the same side, that tends to lead to a turning point. You know, everybody saunters into the theater at different times. When the show's over, you're done. You go to a football game and you're pissed. You know, why don't they have an 8-lane wide highway for when the 8 weekends a year I want to leave this football stadium? Because it is all about, you know, you and me, and that's how we think. But that doesn't make any sense. Markets are going to turn because first they get tired, and then they turn first, and then people talk about the policy mistakes. It's not going to be a policy mistake first, and then it turns.
Well, markets typically top on the backdrop of good news, and we have a lot of good news that's been going around.
Absolutely. And also math works. You can't compound at the same rate of speed. The top 5 stocks that have gone up, and I read all the time in your daily letter, count for so much attribution. If they go up at the same rate of speed they've gone up, in 5 years they'll be the only stocks in the world. I'm pretty sure we're going to have more than 5 companies in the world in 5 years. Yeah. And if we don't, we're in real trouble.
What you're talking about is the top 5 NASDAQ stocks attributed 50% of the total gain from almost any time period from 09. Let's go back February 16's low. They've just really concentrated the attribution. Even though breadth is good, a lot of stocks are working, but those market caps
because they're cap-weighted stocks. So again, it's a second derivative issue. That's what I keep trying to explain to people. If the top 20 stocks in the S&P 500 account for 30% of the market capitalization, and they double, right? Even if the bottom ones double at the same time, they're going to have, because they already started, they're ahead of the game. The separation goes. It's the nature of the compounding aspect. It's not sustainable. Doesn't mean it's going down, it just means it's not going up at the same rate of speed.
Here's a topic that a lot of people are talking about, the inflows into passive funds, ETFs. We're active managers. What do you think could happen here with so much, $1 billion going into Vanguard a day?
Well, at the beginning of a bull market, everybody wants to be a trader when they should be an investor because they remember recent history. At the end, they all want to be investors when they should be traders. Why? What's the worst thing you can have in a bull market is risk management, because time bails you out. So any active manager that has risk management or looks at the fundamentals and say it's too stretched is going to underperform. And so that's not tolerable because you're looking at an index and you're looking backwards. One of my trading slide presentations are, you know, never minimize the pain when looking backwards from a positive outcome.
It's a very, very, very good point. Now, the current state of affairs in the hedge fund world, Quad Group is an accelerator. You find small funds and you help them grow. You do a lot of the infrastructure. You find traders. You look for those Michael Jordans on the bulls. Tell me what
when they're in
see.
high school.
I have young kids. I'll send you the resume. Tell me a couple things. What you look for in a great trader, some of the nitty-gritty aspects. Tell me about the 2 and 20 model. I want to know your thoughts
interesting questions. First, I'm gonna start with the aspect of what we do and what we don't do. So we don't compete in the high frequency space. I can't compete with Citadel or Renaissance or Two Sigma. Those guys are far smarter than I am, and we're gonna leave that to them. As I said earlier, in long run trading, I don't think anybody wants to pay me 2% to be long Google. I don't believe the 2 and 20 model is done, because you're going to pay for talent, just as you said, for Michael Jordan or LeBron James. We try to find, nurture, develop, and grow emerging managers. They have to have a real-time track record. Every successful trader has a near-death experience. I just hope that they have it before they come to us. So it's not the loss, it's how you recover from that loss is important to me. How I see that, how you look at that. Did you change your trading style? So we look at daily data. Returns are not predictable, but volatility is far more predictable, because that's a reflection of one's personality. The mistake that people make in looking at the market today, and they've seen this strong uptrend, is that they assume that's going to continue. We can't assume that, but if you're a discretionary trader, and even if you're a systematic trader, you, the person that developed the system, has a personality, and that's reflected in the volatility of that system. So we look at that. We think that the 2 and 20 model for alpha generating, capacity constrained strategies is still there, because people can't get that. So what we do is we find them, we nurture them, we grow them, and then we put them together in a multi-manager, multi-strategy hedge fund, where you get superior performance without single strategy risk. And we as partners are taking the netting risk. So that's also important from our perspective, that we understand the risk management and volatility of what we are getting into. So should a multi-billion-dollar pension plan be in this business? Probably not, because it doesn't move their needle to be in a alpha generating capacity constrained strategy. So we look at sort of what I call 1 week to 3 months sort of an earning cycle, where you can do the combination of technical and fundamentals, or the buzzword today is quantamental. You want to do your homework, you want to be disciplined, and that's what we're going to look for in traders. Anyone who's watching this today, and if I ask you this question, if you wake up in the morning and before you go to the bathroom, if you're not looking at what S&P futures are, you're probably not committed enough for me.
Guilty. I sleep with my phone. It's you know, a little bit of a issue with my wife over the years. So you look for these young traders.
They don't have to be young. They have to be experienced. As I say, young guys have all the moves, but old guys win championships.
You were 27 in that trader video. Blonde hair, really, you know, eager. Sat next to Paul. You're right there. You're walking around New York, the Quotrex, which, for a lot of people that don't know, it was a handheld device, look about this big, with a big antenna, and it had S&P futures and quotes going through there wirelessly. And it was a really, you know,
it was technologically advanced, totally committed. Again, an investment in technology and also better peripheral vision, so I didn't get hit.
But now here you are. You're matured. You have a little gray hair, and you have
Thank
wisdom.
you for that.
If you can go back with the knowledge that you have, how would you do things different, or would you?
What a wonderful question, because this is a business where, you know, you always look back. We think, oh, I should have done this. I shoulda, coulda, woulda. You can't live your life that way, and particularly in the markets. I should have bought this, I shouldn't have done that, I should have got stopped out, I didn't get stopped out, I should have been longer. The difference between being young in that period of time is, as I said at the very beginning, is the difference between running a business and taking positions and managing money. The path is important. And I think that's, you know, because again, we had redemptions. even after we did well, because we continue to have volatility. But would I do things differently? When you look back from here with a little gray hair, yeah, I wish I was, this is a humbling business. I wish I got more humble before the market kicked my ass. This is what happens. You think you know everything, and then it slaps you in the face. It's a human capital business. It's super, super important to make sure that the good human capital that you have, just like we try to do with managers, that you grow them, you nurture them, and you develop them. And you give them an opportunity to rise and shine. Turnover in a business, not through your own doing, but because you didn't pay them enough, or because you didn't provide them a sufficient opportunity, and then they went to another firm, is something that I wish that I was more alert of that, certainly in the earlier days.
If you were to create a system with all the great traders that you've worked for, including Paul Jones, could you do it?
No. In fact, we used to kid around of, could we put Paul in a box? And the funny thing is that really good people in this business, they work so hard because they don't want to work. That's the irony. You have to live, breathe, and think, and just, act in every sort of conscious moment. If you're an active trader, think about that. And it's a tough business. I consider myself now a coach, not a player, because it's like you have to be mentally in shape, you have to be physically in shape to really be an excellent trader. And so there's the intangibles of that. There's some superstars, and then there's other interchangeable spots. This on the floor, this is a business where we look out the outlier, and everybody thinks they can be the next Paul Jones, they can be the next Stanley Druckenmiller, they can be the next David Tepper. And then they get on and they talk about CNBC, and it makes it look easy. Every superstar in every one of their sports makes it look easy. We're going to watch the Winter Olympics in a couple of weeks. The ice skaters, I don't do any of these sports, but you look at it on television, you go, oh, it's so graceful, it's so easy, it seems like a lot of fun. It's not. It's a tremendous amount of work, what goes into the background there. You cannot take one of these guys and replicate them. That's why systematic trading is successful in very short run, high frequency trading. That's where the world has changed dramatically. The cost of data, the cost of transactions, the cost of execution has gone down significantly. And that makes sense. You can predict not too far in front of you. The game of trying to predict months ahead, weeks ahead, years ahead, my crystal ball gets foggy real soon. I don't do that. That's not predicting. That's kind of gossiping. Trading and success is about eliminating the distractions and the gossiping and focusing on the discipline and the decision making, and that means risk management and really realizing when you're wrong.
You mentioned sports, and I'll say I live in the same neighborhood as Paul Jones, and I see him out there walking every night, and he's out, exercising. And is that required in the business that we're in to stay in a physical, go to a gym, run, ride bikes, play basketball? Is that required to stay focused and mentally download all the...
It doesn't have to be that particular activity, but it needs to be something where you can try to not think and clear your mind for a little while. For me, it's trying to run up and down the basketball court because I'm not thinking about markets. Sometimes I'm right up there and I'm emailing and doing stuff and I'm looking at it and maybe it's 5:58 and I'm going to not go on until 6:02 because I want to see where the futures are opening, but you need something to get away, to recharge and do that. And yeah, so sports is part of it, but whether it's reading or whether it's sailing, and it's there. And the thing you talked about, wisdom, is try to be present when you're with your family. And that's so hard when the markets are open 24 hours a day, you know, almost 7 days a week, except from, you know, even on Saturdays in the Middle East now with Bitcoin and currency trading, it's not a lot of time off. So you need to try to be present the best you can. It's not only, you think it's great for your family, and it is, but it's really healthy for you because it keeps things in perspective. And to this day, I'm still working on it.
You've actually just helped me a little here, a little coaching, free coaching, because I'm guilty of looking at my phone. I've always been doing it with, you know, working for a hedge fund. Just got to know when the PM's going to hit you and say, you know, what's going on in the Nikkei, and you're trying to eat. And so I totally agree as far as getting away, and I recommend a lot of young traders and traders of all ages, I guess, to find an outlet to get away, unplug, and go away to a vacation where there's no Wi-Fi. It's pretty amazing how you feel when you come back.
There's a big distinction between if you're trading for your own account or you're a relatively fairly frequent trader where you can get flat and do that. Because the market's always going to be there. If you're in one of these situations where, like, if I leave, I'm going to miss an opportunity, there's always opportunities. And in our business, I always describe it as there's always opportunities to lose money. It's always there, but you can do that. But if you're running a business and you're managing other people's assets and it's a hedge fund, that's where we look at organization, number 2, risk. Because I don't care who you are, you have to somehow figure out a way to decompress. The more experience you get, the bigger the thing. It might be for a shorter period of time because you have more experience and you're able to do it. Is it 24 hours? Is it 72 hours? Somewhere in there, but you're going to come back and you're going to be better at it for your investors, but more importantly, you're going to be a better manager and you're going to be a better employer because of that, and you're going to reflect. And we've had people, and I've had people that work all the time, and I tell them, guess what? If you get sick, you're not doing me any good, and you're not doing your family any good. Get out of here. Get healthy. You need that. No matter how great they are, you need an off day.
Drawdowns. How do you come back from a drawdown? I know at Tudor, they had a policy where they would send you home for a couple days and just unplug, come back, but you're shut down after a little drawdown. And I think that works. What do you do?
We're in the more active trading business, and you get paid by making new highs and getting in incentive fee territory. So we want to see volatility low. I learned from I like to think the best in Paul and that culture. So we're very similar. If you're down a little bit, we may tap you on the shoulder and say, hey, what's happening? You want to discuss it? We're not going to do anything. If you get down a little bit more, we're going to cut your stuff 50%. If you make a third of that back and you feel like you're in the game, and we'll give you back the capital. And if you're down a certain percent and then you continue to go down, we will go. And as I've said for a long, long time, I've always described it as a park bench day, where you go out and you sit on the park bench and you put your head in your hands and you go, why am I in this business? If you get out of everything, you feel mentally great. And so though they get off the bench and they're out of everything and they feel mentally great, many of them don't get back in the business. The winners can get back in the business, and they realize that that's where it is. And that's a big distinction after that drawdown, after that failure, particularly early on in their career, because there's no worse feeling than losing money. If we tie that into today, everybody marks their portfolio to the high tick. If this deflation spreads, combined with a market decline, I think that there's a pretty good chance that people will feel poorer far more quickly, and that will lead to sort of the negative cycle accelerating in terms of economic growth. That's my largest concern.
Well, we see ads on television today for day trading workshops or classes. We're seeing ETFs that are put-selling ETFs where there doesn't seem like there's much risk to doing all of these things. That's an environment that I think is sort of a late cycle.
Are you talking risk? Are you one American?
No,
Are you a communist? What's going on here? As far as I know, it goes up. Every day it goes up, and I'm proud to be an American.
Well, look, I'm very proud to be an American as well. I'm just a risk manager, and I'm looking at a lot of different factors out there that it's a late cycle. You've had almost 15 months of every month up, and when it comes, I think it's going to be a sharp wake-up call.
I don't know. You think I look any older today than I did yesterday?
You look so good.
Yeah, do you think I'm going to look any older tomorrow than I do today? Probably not. So that's a trend. The trend's never going to change. I'm never going to get old, and I feel great about that. So that's how you should think about the market. It's gone up yesterday. It's likely to go up tomorrow. It's going to go up forever, and it's never going to end. So what do you need risk for?
What are we doing here? We should just go out and buy the S&P, maybe buy calls in the S&P.
Exactly. I'm really annoyed that I paid for my kids' college tuition. I could have taken all that money and put it in the S&Ps, and they would be wealthier. I think we talked about that before we started. Are you better off being uneducated and rich, or rich and and educated and having a lot less money? Because that's where it is today. It all seems very simple. I can assure you that after the fact, it is not.
Well, look at what we have happening, the crypto phenomena, Bitcoin. And we just saw it run up, I think, 32 million% from 2010. And if you put $10,000 in it, you would have somewhere around $3.2 billion. And it seemed like everybody was asking me about it. People that, it was like that shoe shine story of, what do you think of
I think
this?
if I invested a penny when Jesus was born and compounded at 7%, I'd be a billionaire now too. You know,
Well,
so
look at, have you ever seen anything? You've never seen anything like this, and it's.
But yes, it's a small market. But for everybody that's looking at Amazon today, go, what a great company. If you recall that it went down 95%, it went from $100 to $5. There are buyers are at higher prices, sellers are at lower prices. That's the irony of the marketplace. I don't know if Bitcoin, I believe in sort of blockchain and new technology and all those other things. Is it there? I don't know. But is it likely to go down 90 to 95% at some point? Maybe we started at 20,000. Maybe we're going to start at 40,000. That's just the nature of markets. I've had a lot of great opportunities in my life. I went out in 1989 to Cupertino to visit with John Scully and talk about Apple on Wall Street and whether they would be willing to support the trading business. And he basically said no. And to this day, there are no Apples on trading desks in Wall Street. They weren't willing to do what it was taking to do that. And we decided we were not going to put them in our office at that time. And Apple almost went broke twice. After the fact, everything is simple.
Well, like you said, you've seen these manias, and they come back down. I think Amazon almost round-tripped twice. I think in 2007 it was down 60%, or 2008, 60%. And you talked about the FANG-like stocks. These stocks are not going to keep growing or going up as they have. And back in 2007, I recognized the Kramer's Four Horsemen stocks were doing the same thing. And if you said to anybody back then, these stocks are going to go down on average of 50% in the next year, they would have thought you're crazy. They're great stocks, hold on to them forever, but you've got to manage that risk of when these things top out. You're looking at these markets right now. What will be a few things that will tip you off that the market is changing?
Well, I think the first thing is that churning and maybe a pickup in daily trading ranges without much net change in price movement. So increased volatility. I'm not talking about VIX or any of those, just underlying instruments without much net price change is an indication of potential trend change. You're going to look for all those particular warning signs. We as traders, you know, we realize it's extended. We realize that it's way far ahead of itself. But I'm not jumping in front of it just because of all the facts that you stated out that it's overbought. I'm going to wait for indications. I'm going to take the opportunity. And it's likely to be wrong. If we go back to Japan and everybody's, oh, look at Japan. It topped in 1989 at close to 40,000. We're at 25,000 now. That's a long time. You know, these things with markets, we all look at our recent history because that's all we do. That's where we live in it. There's an entire generation. Think about that. In a year or two, every college graduate, 9/11 is only going to be seen as we look at World War II, or our kids look at the 95 bombing in New York, or other people look at Vietnam. It's only in museums and history books. This is a business, unfortunately, where you have to live it real time. The real time right now, again, is always trying to make you lose your discipline. The real time is buy the dip, there's no volatility. It will change. You look for those warning signs, but you can't change. You know, if I say, if you want to forecast, forecast often. We want to do this in a week from now, and something's changed, I'll say it's changed. I have, the one thing you ask about wisdom, I've got no ego, I've got no pride of authorship. Our goal at Quad Group is that more money is better than less. And you do that through a rigorous, disciplined process, not by pretending you're smarter than everybody else, because you're definitely not. Or I'm certainly not.
Well, I would agree. I think the discipline aspect of trading is essential, and everybody knows that. But people often fall right off their discipline. They make excuses, they rationalize, they do whatever. And you see that. You're a coach. You see that type of mentality, and you tap them on the shoulder. You have to make changes. Did you ever get tapped on the shoulder?
Absolutely. I mean, that's, again, you said that earlier about how you learn and live from your mistakes and apologize for the wording. But, you know, one of the great movies of all time is the Outlaw Josie Wales. And there's a scene in there where it's exactly the tap on the shoulder, right? Don't piss down my back and tell me it's raining. You have to have a friend and somebody that you respect that's going to tell you that. And that's how you learn. And then you have to reflect and think about yourself and have to want to get better. If you're blaming other people, if you're blaming the refs, if you're blaming the umpire, if you're blaming the fact that it's snowy or rainy or whatever excuse that you want to make, that you had a bad soybean position, or it's Friday and it's an expiration, or the government intervened, or somebody opened their mouth, you're looking in the wrong area. There's only one place to look, and that's in the mirror. When I talk about, you know, looking in the mirror and that, of course, I'm not a day older and my hair is completely blonde, I think that that's a self-actualization moment that we all think of ourselves differently than other people think of us. And if we don't learn from our mistakes, we're going to make them probably bigger and worse the next time around. That's the greatest thing about aging, is that you're going to make mistakes, but if you're good at it, you're making new and different mistakes. In the trading business, you don't want to make the same mistakes. So that's where experience comes into play. And if that experience of the fact that that kid who had blonde hair versus the kid today, I guess I'm not a kid, but the person today who has gray hair says, I've seen that before, I'm not going to fall for that trap again in the market. And that can be all sorts of different things. Around how many times have we taken too big of positions into earnings? How many times do we think that we know better than the marketplace going into earnings? And then you're on the wrong side. So you've ended up risking way more than you thought you should have, back to Kelly criteria, it's a mistake. Learn from your mistakes. Look back at that kid in the mirror who was young and say, okay, as the old Bob Dylan says, I was so much older then, I'm younger than that now.
I think that this interview has been exceptionally helpful. You've talked a lot about discipline, you've talked about the markets. I think we've picked up a lot of information, and I just want to thank you for joining us today on Real Vision.
Well, thank you. I'm happy to be here. If I could just leave with one last line for everybody in trading: discipline before vision.
Perfect. I want to thank Peter Borish for coming in today and talking with us on Real Vision. I have been a friend of Peter for a long time, and I learned a lot. And one of the most important things I learned were some of the aspects of what it takes to be a great trader. And I think everybody can take away from this interview a little bit of that and put it into their trading. So thanks again, Peter. See you again on Real Vision.
Thank you for watching this interview. This is just a taste of what we do at Real Vision. To learn more about the complex world of finance, business, and the global economy, click on the membership link in the description. Give us 7 days to change your life. This will be the best dollar you ever invest.